wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets, so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 207, and in this episode we are reviewing the performance of the financial markets during the 14th week of 2026, and that is from Monday the 6th to Friday the 10th of April. And without further ado, this is your host Jamhuri, and together, let's dive right in. We kick it off in the United States, where, according to a Bureau of Labor Statistics report released on Friday, consumer prices spiked in March as the war against Iran sent oil prices soaring and took the Federal Reserve further from its inflation target. The Consumer Price Index increased by a seasonally adjusted 0.9% in the month of March, putting the annual rate of inflation at 3.3%, driven by a 10.9% surge in energy costs. Both numbers were in line with the Dow Jones consensus, and the annual rate of inflation was the highest since April 2024 and was up from 2.4% in February. However, excluding food and energy prices, core inflation came in at just 0.2% for the month and at 2.6% on an annual basis, indicating that underlying inflation remained contained. The Iran conflict was a story for the monthly inflation reading, as gasoline prices soared by 21.2%, accounting for nearly 3/4 of the increase in headline inflation. And in related news, according to the Fed's preferred measure for inflation, core inflation in the month of February continued to trend above the Federal Reserve's target rate of 2%. This inflation data for February was taken before the recent surge in energy prices and offers the Federal Reserve a snapshot of economic conditions leading into the war against Iran. The Commerce Department reported that the core personal consumption expenditures price index, which excludes food and energy prices, this rose by a seasonally adjusted rate of 3% in the month of February, whilst the all-inclusive headline rate of inflation increased by 2.8%. For your information, the Fed uses the core PCE price index as its primary forecasting tool for inflation because it is a better indicator of longer-term inflation trends. And according to a University of Michigan survey released on Friday, consumer confidence plunged to a record low in the month of April as fears mounted over rising energy prices and the broader impact of the war against Iran. The university's headline index of consumer sentiment tumbled to 47.6 and was down by 10.7% from the March survey, to its lowest level ever on record. The drop in sentiment coincided with a sharp spike in inflation expectations, with respondents seeing prices increasing by 4.8% 1 year from now. Remaining stateside, Jamie Dimon is warning that the U.S.-Israeli war against Iran could lead to another round of persistent inflation and higher interest rates that could sink the U.S. economy into a recession. In his annual letter to shareholders that was released on Monday, the 6th of April, the CEO of JP Morgan painted a mostly rosy picture of the U.S. economy in 2026. However, Dimon said that whilst the U.S. economy was on firmer ground now than in years past, that does not insulate America from the prevailing economic challenges that are taking place around the world and does not negate the possibility of an economic recession. The U.S. war against Iran increases the risk for significant and persistent price shocks, mainly from oil, but also from other related commodities such as fertilizers. Dimon warned that the ongoing war, if it persists, could disrupt global supply chains, and that could lead to another round of sticky inflation and higher interest rates from the Federal Reserve, as well as other major central banks. On Wall Street this past week, the S&P 500 fell slightly on Friday, but the index still managed to post a solid weekly gain as traders kept an eye on the fragile 2-week ceasefire agreement between the U.S. and Iran. President Trump on Friday accused Iran of extortion as it was reportedly charging fees to oil tankers passing through the Strait of Hormuz. All the three major indices posted their best weekly performances since November 2025, with the Dow Jones Industrial Average posting a gain of 3% for the week before closing at 47,916. Meanwhile, the S&P 500 was up by about 3.6% for the week before closing the session at 6,816, whilst the tech-heavy Nasdaq Composite rose by about 4.7% during the week before coming to a close at 22,902, bolstered by gains recorded by key semiconductor stocks such as Nvidia and Broadcom. In the U.S. bond market, U.S. Treasury yields rose slightly on Friday after the latest inflation print showed core prices rising less than expected, given the surge in energy prices resulting from the U.S. war against Iran. This past week, President Trump called for a ceasefire, suspending attacks for 2 weeks amid ongoing negotiations with Iran. Later in the week, however, the president warned Iran not to charge fees for oil tankers passing through the Strait of Hormuz. Even before the war began in late February, inflation was still hovering above the Fed's 2% target rate and has been there for the past 5 years. The Middle East conflict has complicated the Fed's rate-setting approach as the central bank weighs the lasting price impact of this energy shock. The yield on the 2-year Treasury note, which is more sensitive to short-term interest rate decisions by the Federal Reserve, rose more than 2 basis points to 3.80%, whilst the yield on the benchmark 10-year U.S. Treasury bond was also up by more than 2 basis points to settle at 4.32%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another. In the commodity markets, the price of crude oil slipped below the $100 threshold on Friday amid persistent tensions around the Strait of Hormuz, with the vital shipping lane still largely closed despite a ceasefire deal between the U.S. and Iran. President Trump has warned Iran to stop charging tankers passing through the Strait of Hormuz as it risks undermining the two-week ceasefire agreement that was contingent on reopening the waterway. The Strait of Hormuz handles about 20% of global oil supply, but has remained severely restricted since the war began, keeping financial markets on edge. However, despite the two-week ceasefire agreement, passage through the Strait of Hormuz remains uncertain, and this continues to sustain upward pressure on crude oil prices. The price of the global benchmark Brent crude fell by 1.3% to settle at $94.69 per barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, traded lower by 1.5% as it came to a close at $96.37 per barrel. In the precious metals market, the price of gold inched up on Friday and was headed for a weekly gain as the US dollar weakened following the ceasefire agreement between the US and Iran, though market participants continued to assess its durability and implications for interest rates. The ceasefire deal has halted a campaign of airstrikes against Iran, but it has yet to ease the blockade of the Strait of Hormuz. In other news, data showed U.S. consumer prices increased by the most in nearly 4 years in the month of March as the war against Iran has boosted oil prices. Continued high inflation limits the central bank's ability to cut interest rates. Meanwhile, bullion is seen as a hedge against inflation and geopolitical uncertainty. However, its appeal to investors tends to fade in a high interest rate environment due to the absence of a regular yield. In closing, the price of spot gold gained over 2% during the week before settling at $4,778 per ounce. We now change scene to the Kenyan financial markets, and as is the norm, we start by looking at the domestic foreign exchange market, where the Kenya shilling appreciated marginally versus the US dollar, but continued to trade within a very narrow range versus the greenback. According to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.53 compared to a rate of 129.99 the previous week. Meanwhile, the sterling pound was priced at 174.12 and the euro was valued at 151.42. And on the regional front, one Kenya shilling was changing hands for 28.60 Ugandan shillings and 19.99 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.27. The IMF has previously raised concern about the extreme stability of the Kenya shilling, but the Central Bank of Kenya continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, We expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, and for the second week in a row, Kenya's usable foreign exchange reserves declined by $340 million for a grand total of $13.31 billion, which is equivalent to 5.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The recent increase in Forex reserves was attributed to the issuance of a dual tranche Eurobond for $2.25 billion, whose proceeds were partly used to buy back existing Eurobonds that were approaching maturity. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. Open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenyan shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 8.75%, which is in line with the current central bank rate, which is at the same rate of 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 6.9 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 9th of April, and the central bank received bids totaling to 24.5 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 102%. The central bank ended up accepting almost the entire amount of bids received, and the results of the auction were as follows. The 91-day rate was stagnant at 7.40%, whilst the 182-day rate was stable at 7.82%, and the 364-day rate also held steady at 8.27%. In the primary bond market, the Central Bank of Kenya has published a prospectus for the reopening of an existing 30-year Treasury bond, as well as the issuance of a new 30-year fixed coupon Treasury bond. Through these prospectus, the central bank is looking to raise a total of 20 billion shillings from the sale of the following treasury bonds, whose terms and conditions are as follows. For the first bond, this is the reopened 30-year bond with 14.9 years left to maturity and a coupon rate of 12% flat. The second bond is a new issue of a 30-year bond. The bond reference number here is FXD1/2026/030, and this bond has a fixed coupon rate of 12.50%. Please note that these bonds are now open for sale until Wednesday, the 15th of April, when the auction will be held. Up next is our topical issue, and this week we're looking at the policy decision by the Central Bank's Monetary Policy Committee. The Central Bank's Monetary Policy Committee held its policy meeting this past week on Wednesday, the 8th of April, and during the meeting, the committee made the following observations. The conflict in the Middle East has disrupted global supply chains, leading to significantly higher energy prices and heightened the risks to the global economic outlook. Prior to the conflict, global growth was projected to remain steady at 3.3% in 2026, but this is now expected to moderate due to the effects of higher inflation and reduced demand arising from higher energy prices and increased uncertainty. Meanwhile, global inflation is expected to increase in 2026 on account of higher energy prices that are attributed to supply disruptions arising from the ongoing conflict. Inflation rates in the major economies have remained above target due to the stickiness in core inflation and the recent increase in energy prices. Central banks in the major economies have recently kept their policy rates unchanged as they assess the impact of the ongoing conflict on domestic inflation and the outlook for economic growth. And back at home in Kenya, the overall rate of inflation stood at 4.4% in March 2026 and was up marginally from 4.3% in February and remains below the midpoint of the central bank's target range, which is 2.5 basis points either above or below the 5% rate. The Kenyan economy remained resilient in 2025, with real GDP growth estimated at 5% compared to a growth of 4.7% in 2024, and this was supported by a rebound in the industrial sector as well as resilience of the services sector and stable growth in the agriculture sector. Meanwhile, the banking sector remained stable and resilient with strong liquidity and capital adequacy ratios, with the ratio of gross non-performing loans rising slightly from 15.4% in December 2025 up to 15.6% in March 2026. Meanwhile, the growth in commercial bank lending to the private sector, this continued to improve from 7.4% in February up to a growth of 8.1% in March 2026. Having considered the above developments, the Monetary Policy Committee concluded that the current monetary policy stance remains appropriate in order to ensure that inflation expectations remain well anchored and the Kenya shilling exchange rate remains stable. The committee therefore decided to maintain the central bank rate at 8.75%. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhurrig@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, you only live once, but if you do it right, once is enough. A quote by Mae West. Think about it. Thank you, and God bless.